all know that when everything goes to custard, there's plenty of people that are making money. But on one hand, we've got people that have wiped out 30% of their super. And on the other hand, people are making money out of this. How are the people making money out of it? Well, they're probably working with PJ Patterson. Now, PJ is a multi-award-winning financial advisor. He saw this crash coming. He moved his clients' money to safety and put them in a position where they could profit. In his coming presentation, he's going to go through the 3 factors that he uses to read an economy. He's going to talk about why your risk profile is probably costing you money. He's going to talk about full cycle investing and why you should really pay attention to that. And he's going to go through his current investment playbook. He's going to give some predictions around how long this recession is going to last. Is it going to be a V-shaped recovery, and a whole bunch more. But before I hand you over to PJ, let me give you a little bit of context as to what this is all about. So you're about to sit in on a session from one of our crisis reinvention team, but let me give you some quick context. When COVID started to seriously impact businesses, we mobilized experts from within the Dent community to be able to help business leaders like yourself navigate the difficult decisions across a variety of topics, including how to access finance and grants, to cash management, to human resource law, to marketing and sales strategies, to cool tools and tech that you can use from home, through to high stakes leadership, health, wellness, stress management, not just for yourself, but for your team, and look, a whole lot more. For the full schedule, with more being added every week, visit dent.global/reinvent, and we hope you find it a useful resource. All right, let's do this.
Hi, Glenn, and thank you very much for that introduction. My name is PJ Patterson. I'm the chairman and founder of Keystone Financial. We're a financial planning firm here in Sydney, Australia, and we specialize in helping our clients risk manage their assets. This is a super important time, and I do think that this presentation may very well be one of the most important presentations you look at all year. And I know that's a bold statement, but given the circumstances that we're in right now, you need to have the unfettered, no BS, tell me what's going on information that will help you potentially save thousands and thousands of dollars. Before I get started though, I unfortunately do need to show you a general advice warning. The suggestions and commentary in this presentation will give you a general idea of the options available to you. You will need to work out what is appropriate for you. That being said, my job today is to give you a number of insights and some tools and to answer some questions about what the heck is going on. And as Oprah Winfrey famously said, surround yourself with people who are going to lift you higher. Now, forgive me if I look around a little bit. I do have some things around me that are going to help jog my memory as to exactly where I am in this presentation, so bear with me if I'm not completely focused on you during the presentation. Let's get started. I'm going to say some scary things to you today, but I don't want you to be scared. Information is knowledge, and knowledge is power, and it will set you free. What I'm going to share with you today are insights and knowledge about where we are, the markets, and what's happened to date, and give you some frameworks for how we might be able to look at markets and gain those insights and knowledge. If you could please stick around to the end, I think you'll find I have put together, or I will share with you rather, that I've put together some great resources specifically for the Dent and KPI community, and I want to be sure that you don't miss out on the opportunity to get those. Now more than ever is an important time in your lives to protect your family's wealth, protect the capital that you currently have, and if you happen to be a really young person, a millennial or a Gen Y or Gen Z or whatever the Gen is now, you will probably get some deep insights into where we are and how you can prepare yourself for the next time this happens, and it's going to happen again. I mean, these things come along every 5 to 7 years or so, and honestly, at this point, the COVID-19 thing is one of those black swan events, but nevertheless, these sorts of market corrections happen all the time. I also suggest that you take some notes today. So grab a piece of paper or open a page in your browser and get ready to type some things down. I'm sure there'll be some things that will that you want to follow up on or that you want to ask some questions about, because frankly, I don't do things in a very orthodox way. Now, don't let that scare you. I think you're going to find that the insights I give you today are not mainstream financial media or the mainstream at all, but they do absolutely work, and the tools and the methods that I use absolutely work, and I'll share more about that shortly. Also, feel free to hit me up in the comments section. Leave comments, post questions on this video. I'm sure that it'll be available to do that, and I would love to hear your commentary and answer any questions that you might have. So let's sit back, take a deep breath, and get ready to learn. So here's what I'm going to cover today. I'm going to give you a quick snapshot of where we are in the economy and what's going on both globally and locally. I'm going to take a look at market volatility and why that matters to you. I'm going to show you how to read an economy using the three-factor model that we use here at Keystone Financial. I'm going to talk about your risk profile and what that actually means to you and why I don't use them or don't think they're really that relevant. I'm going to discuss with you why you should consider becoming a full cycle investor, what that actually means, and how to actually look at implementing a full cycle investment strategy. And finally, I'm going to talk about the playbook we have on right now for our clients and how that might help you in protecting your capital and your wealth. Right now, the global economy and global financial markets are in crash mode. I know that's a bold thing to say, but anything beyond about a 20% correction in markets is considered a crash. And here's a couple of statistics. Bear with me while I read these off the screen. Here's a couple of stats of markets as at when I'm recording this, which is the Friday, the 4th of April. So the Dow Jones Industrial Average was down 26%. This is year to date, by the way. The S&P 500 is down 23%. The Nikkei is down 24.5%. The Australian All Ordinaries was down 24%. The FTSE is down 28%. And the DAX, which is the German index, is down 28%. Now, I could go on and on about other stock market indices around the world, but they would all be very similar. You would all get the same feel that we are absolutely in an economic crash. The other issue is that all of the metrics that are tracked right now globally with all of the data points and econometric data points that come out, particularly out of the G20 countries, are horrendous and they're deteriorating. And this is a very key thing to understand about knowing where we are in the world today and how you should be potentially viewing the world, as well as how you should be investing. And right now, it's not a very safe environment to invest because all of the econometrics are continuing to decelerate. And that is a very, very bad sign for probably the short and medium term. Before we are really, it's safe to go back in the water, as it were, we need to see GDP figures and things of that nature going up. In fact, one of the things I might actually suggest is that we do have an ongoing market crash. Now, I know we may see the markets have a little bit of a pop this week. I don't know. It depends on when you're viewing this. But we're definitely in a bear market. And typically what happens in bear markets is you see a violent crash to the downside, so it really just falls off of a cliff, and you'll see these really powerful rallies inside of a bear market. This is typical. This has gone on for years, or not gone on for years, but it's a very repeatable and known thing about bear markets. And the thing you need to, again, rely upon is what is the economic data telling you. And I'm going to get into that in just a moment. But before I do that, I just want to say that I am particularly proud of the fact that my firm saw an economic slowdown coming. Now, we didn't see COVID-19. I'm going to be absolutely upfront about that. No one would have seen COVID-19 coming and the impact it would have had on the global economy. That's kind of referred to as a black swan. You might have heard that term bantied around the media in the last 10 or 15 years, particularly after the GFC. Everybody, talked about these black swan events. Well, COVID-19 would certainly be classified as one of those. But I was already positioned with my clients' money in for a declining economic environment. We were sort of headed this way anyway. Now, would it have been this bad? I don't know. Probably not. But certainly because the world economy has, for all intents and purposes, been shut down because we're trying to keep people to stay at home and restricting movement, and airlines have really restricted the number of flights they have now, and it's really only essential services and essential movement. This is going to have a huge impact. It already is, but it's going to have a huge impact on the global economy. And I dare say when we start to get the GDP numbers coming through from all of the, again, G20 economies, we're going to see some really, really horrendous and bad GDP numbers. And that is not a good thing for you or me. As a result of the markets crashing and all of this up and down movement, what we're actually seeing is the volatility of markets has increased. And this is a really important metric and something that you should be aware of. And if you're not aware of it, well, you're about to be, because it's one of the most powerful tools you can use to determine when it's safe to invest. And I look at, volatility is the measurement of price movement over time. So the more price moves and the bigger the moves, the more volatile you'll see, or the more volatility you see in the market. And one of the measures that we use for volatility in my business is the VIX, which is the S&P 500's volatility. And there's basically 3 regimes of volatility. You could probably already guess what I'm about to say, but the first regime is sort of the safe regime. It's where it's a green light, and I sort of hearken all this to a traffic light system, and that's what volatility gives you. So, pardon me, bear with me for one sec while I explain this, and then I'll tie it back together again. But volatility has 3 regimes. The first regime is green, everything's fine, market's going great. That's where you get your captain stock picker. Everybody's a winner in stocks, and it's just one of those things where it seems like you can do no wrong. You can almost throw a dart at the market and have a winner. The second measure of volatility is a yellow light. It's where volatility moves into a certain range that is caution. And often what you see there is a lot of chop. You'll see markets shooting up and down and up and down and up and down. There's just a lot of movement in the markets, and that's a great trader's market if you want to do that sort of thing, but most of us don't have the capacity, time, or even skill set to trade the market over very short terms. But anyway, that's a yellow light in terms of volatility. Now, the red light is when volatility gets so extreme that the volatility indexes, and the one I mentioned earlier was the VIX. If you popped into Yahoo Finance or something like that right now and put the ticker symbol VIX in, you would get the VIX volatility index. And so when volatility reaches extreme points, it becomes a red light, a stop. Basically, don't go into the water, don't go into this market. And so the ranges for that are as follows. The green range, the general range where everything is fine and you can invest and not really worry about what's going on in the market, is sort of a volatility measure of 9 to 15. And if you've bothered pulling up that chart, and maybe just pause this right now and pull up the chart of the VIX. It might be a little fun exercise for you to do. And go back about 6 months. You'll see that the VIX range was right around in that 9 to 15 level. And it was there for a long time. And coincidentally, we had quite a bull market going on for quite a long time, since about 2000. Late 2017, early 2018, we started a bull market. Anyway, that's the green volatility bucket, 9 to 15. The yellow volatility bucket is sort of 18 to 25 to 28, somewhere in that range. That's where, again, you're cautious and you're seeing a lot of chop in the market, and it's not necessarily a sign that you need to sell your assets, but it's certainly a time where you might be saying, well, I don't know if I want to allocate new capital here, or you want to look for asset classes where they have lower volatility. Finally, the red bucket, which is the no-go bucket. This is the bucket of volatility where effectively the stock market becomes uninvestable, or an asset class becomes uninvestable. And it does depend on asset class. I'm speaking more broadly here about stocks, but that is a volatility level above 31. Once you get above 31, then the market really becomes and this is a technical financial term, it becomes a shit show, and you really should be sitting on your hands. In fact, you should probably be considering taking money off the table, because what happens with volatility is that assets and cash flow to markets or asset classes that have low or falling volatility. So the opposite is also true. As volatility rises and price movements get more extreme, cash moves away from that sort of asset class. So why is volatility real important? Well, it's one of the key components of risk that we look at. So as volatility rises, risk is rising, and that is the lesson for you on volatility. So right now, where are we in the markets? Well, I've just given you a real awesome primer on what volatility is all about. So if you have gone on to Yahoo, you know that the volatility measure on the S&P 500 on, well, Friday, April 4th, closed, I believe, at 46. Now, it's been as high, and hold on for this one, right? It's been as high as 82, I believe, 82 or 83 intraday. That is ridiculous, face-melting volatility. As an investor, you just cannot be in a market with that kind of volatility. Even at 46, it's still above the level that I gave you for red, which is 31. So it just means, you know what, you can't invest in asset classes with that kind of volatility. Now, every asset class has its own volatility metric. So whilst I've given you those three buckets, that generally applies to stocks, and broad market indexes, but it won't be the same for something like oil or something like treasuries or sovereign debt or currencies, even for that matter. They all have their own volatility measures, and they all have that sort of green, yellow, and red light metric. Now, the other thing that, not the other thing, but the next thing I should say that we look at in terms of looking at markets and how we the lens that we look at through them is a three-factor economic model. And the thing I like about this model is it's very simple, and it's global macro, and that's the level that we start at. We look at, first of all, what's going on globally, what is the global macro environment telling us, and the three factors that we look at are growth, or GDP, inflation, and interest rates. And I'm going to go into each of those in just a little bit more detail now. So growth, or GDP, as you can imagine, if a country's growing, its GDP is growing, and prosperity is happening, money's flowing, that country's manufacturing stuff, the services industry is going well, jobs are being created, and broadly speaking, the overall wealth of a nation is rising. And that's a great environment to be in. You want to see GDP rising. Now, as I mentioned a little bit ago, there's every chance that the US and many other countries that you're probably watching this video from, so Australia, Singapore, Hong Kong, well, actually the Chinese probably wouldn't let this in on their internet, but maybe Taiwan, Korea, Canada, and New Zealand. These countries' GDPs are all going to fall. Now, if you don't believe me, just give it some time. They're all falling, and they will all have varying degrees of negative GDP over the next couple of quarters. Now, does that mean that we are in a recession? Most likely. It further could mean, and we won't know this actually until we get months and months beyond this. So the thing about knowing whether you've had a recession or even a depression, you almost don't really know that until possibly quarters ahead or months ahead. So the data will tell us and give us a pretty likely or probable scenario there. But certainly my call and my view is we're in a recession right now in Australia. The US is in recession, Europe's in recession, most places in the world are in recession. And it's not going to get any better anytime quick. So that's the first factor, GDP. The second factor is inflation. Now, we all pretty much know what inflation is. It is a measure of prices. And we see that often when we go to the pump, to the petrol station to fill up. If gas prices or petrol prices are higher, that's a sign of inflation. If they're lower, that's a sign of deflation. Similarly, if you go to the shops and you do your weekly grocery shop, you might see that the cost of the things that you are buying, or the basket of goods that you have, is getting more expensive over time. And pardon me, that is a measure of inflation. So what we actually want to see is, we actually like to see moderate levels of inflation. A lot of the central banks, and I won't go into all of this really in detail, but a lot of the central banks like to try to generate inflation because it helps with other parts of the economy. But the reality is that for you and I as consumers, deflation is actually our friend, right? If you think about it, what are the things that have been deflating in price over the last, say, 25, 30 years? It's been things like TVs and computers and all of the things that we kind of don't need but we want, right? All those little gadgets and things, they seem to be going down in price. But all this stuff that we actually need on a day-to-day basis, like the cost of housing and food and petrol and insurance and health insurance, all of those things go up. So inflation isn't necessarily a great thing, but it is one of those metrics that we look at. Now, finally, the other metric that we look at is interest rates. Now, as you would almost undoubtedly know, if you've been watching any of the mainstream media stuff and financial media, you know that interest rates drive a large part of our economy. So as interest rates fall, that's good. That usually means that debt is getting cheaper, and they're trying to maybe promote a little bit of economic growth. And commensurately, if interest rates go up a little bit, that's also a healthy sign that the economies are probably, growing, and they want to make sure that we don't get into a hyperinflationary or a high inflation environment, so they increase interest rate. It's one of the policy tools that central bankers use to control the supply of money in an economy, but it's certainly one of the key metrics that you and I, as individual consumers and homeowners and all the rest of it, use to govern how much money we have to spend, how much we allocate towards or discretionary spending, that sort of thing, based on how much we have to spend on things like debt and revolving debt. So anyway, that's the three-factor model that we use. Now, generally speaking, we want to see, there are two levels, and this then goes into how our quadrant model works. And there's basically four quadrants. So let me just recap for a second. Growth, inflation, and interest rates. Three-factor model, global macro. The direction of those three things put us into four different quadrants. The first two quadrants are good. So growth is rising, inflation, moderate to maybe rising a little bit or falling a little bit, and interest rates, again, probably not extreme, going to one extreme or the other, just a normal policy setting, normal cost of money type thing. That's quadrant 1 and 2, and that pretty much means we are in a growth phase. We're seeing that GDP is growing, and we're seeing that the world economy and large nations like the US and China and Korea and all of these guys, if they're in quads 1 or 2, it means global trade is moving and things are going well. It's kind of a happy time. It's a Goldilocks time, if you've ever heard that term before. Now, on the flip side of that, quads 3 and 4 are bad. And so quad 3 and quad 4 basically mean that, or we're basically seeing that growth or GDP is falling. Inflation we might be in a deflation. So inflation is probably falling, and it's falling fast. And interest rates are usually being cut as well. And that is because we have a problem with growth and a problem with economic growth, and we need to be able to, or they're trying to actually stimulate growth by cutting interest rates. So where are we right now in terms of the economic situation in Australia? Well, we're in quad 4, which is very much a recessionary quad, and in fact, we are so deep into quad 4, as I said earlier, this could very well be a depression. And as an investor, this pretty much means that we got to batten down the hatches. And as far as not being an investor or just being a normal human being, it also means we need to batten down the hatches, because there could be some very unsavory things headed our way in terms of additional job losses, further slowing of the economy, further restriction of movement. We're really in uncharted waters here in terms of how the COVID-19 situation is playing out across the globe and what it truly is going to mean long-term for the global economy. I personally think that we're going to see some positive things in terms of new ways to manage the global workforce, in terms of things like working from home and more flexible working arrangements and maybe not needing, office space, this sort of thing. That's going to take a while to play out, and in between that happening and today, there could very well be a lot of pain and suffering amongst most of the population who maybe don't have secure jobs and things like that. So anyway, I'm sort of coming at this from an investor point of view and how to protect your capital, your superannuation money, and so forth. So let's get into a discussion around risk. I love this slide from Warren Buffett where he says risk comes from not knowing what you're doing. And it's a pretty common thing where, as I described earlier in the volatility regimes, when volatility is low, I see it all the time. I get, the captain stock picker. Everyone has some punt or tip on the stock market because everything's kind of going up and everybody's a winner. And people think, well, I don't really need to understand risk management. I'll just pile all my money into this one opportunity or two opportunities and make a gazillion dollars. Well, look, I am over-exaggerating on some of that stuff, but you'd be surprised at the number of people I've come across throughout my career where that's how they invest. And it's a very, very scary thing. I think most investors make the wrong decisions, first of all, because they don't have the tool set. As what I'm giving you today, some of the tools that you can use to really get an idea for where you are in the investment cycle, the economic cycle, and maybe what you should be investing in. I'm going to talk a little bit more about that later. But as we all know, a lot of investors buy high and sell low, right? It should be the other way around, buy low and sell high. And they just make bad investment decisions. They don't size their positions accordingly. They invest in the wrong industries at the wrong time in the cycle. It's just a veritable shit show of mistakes that people make. And I think part of what drives that is this risk profile thing that goes on it goes on in Australia in the financial planning industry, and I suspect pretty much any country, US, in any country in Europe, Korea, etc., will have these risk profile questionnaires that people are asked to fill out. So when you're working with an advisor, one of the things they're going to ask you to do is fill out a risk profile questionnaire. If you have a superannuation account in Australia, likely you'll at least just tick a box to say I'm a balanced investor or something like that, but they might actually have you fill out a risk profile questionnaire. And I think about these risk profile questionnaires in a different way. And I'm going to give you an analogy. It's like asking you, how many pairs of shoes do you have in your wardrobe? And the reason I use this analogy is because a risk profile is like having one pair of shoes in your wardrobe. And what I mean by that is if you are put into, let's say, a balanced profile, it means that advisor or that fund or whoever it is that's managing your money is going to manage your money exactly as a balanced investor through the entire cycle. So if you think about where we're at right now, we're coming into winter, right? In the market cycle, it's going to be bad. It's going to be a really cold winter. And if all you have is a pair of flip-flops or a pair of high heels or a pair of tennis shoes or a pair of sandals, right? That's the only pair of shoes you've got. You're not going to do too well in winter, right? If it's snowy and icy and it's really bad conditions, that's the wrong footwear to have for the market environment. And unfortunately, as I say, the way that the mainstream market, financial media and financial establishment treats you is by saying, you're this type of investor, we're going to manage your money exactly the same way through the entire cycle. Now, I think that is completely stupid. And I'm going to tell you why I think that. if you consider that we have a business cycle, everyone knows that we have a business cycle. We go through a business cycle. There are certain points in that business cycle where you should be able to, say, take a much more defensive posture, where you might actually get out of growth stocks and value stocks and the things that do really well in quads 1 and 2, as I described earlier, and move more defensively into bonds and fixed income and treasuries and cash and all that sort of thing. By the same token, when that environment, when the winter resolves itself and we see spring and summer coming, you want to be able to do the same thing. You want to get out of those defensive assets and pile into, maybe overweight some of the growth assets and things like that. But here's what the financial establishment does, is they go, no, you're a long-term investor. We're not going to worry about trying to time the market, and we'll just invest you this way throughout the cycle, because you've got 30 or 40 years or 50 years or whatever your investment horizon may be. Now, again, I think that's ludicrous, because I also believe that it is absolutely possible to time the market. Now, I'm not talking about timing the absolute day the market tops or bottoms, but if you understand, or anything I said earlier about GDP and the three-factor model and interest rates and inflation, if any of that resonates with you, then you would be able to then filter that down into a playbook to say, when these things are happening, depending upon the quad we're in, there's a playbook for me to invest. There's a certain type of investment playbook that I need to put on. And in doing so, it improves the probability that you're going to, A, have a positive return, and B, not lose a shitload of money when we get something like a correction or crash. So the problem with a risk profile is it really shouldn't be called that. It should be called an investment profile, because that's what it does, is it lumps you into a style of investment. A risk profile is much different, and managing risk is much different. And again, it is one of those things where you need additional tools to understand where you are in the market cycle and what's going on with things like volatility, and particularly in certain asset classes, to really understand how you should be investing and the types of investments you should be making. Because at the end of the day, everybody wants to see their capital grow. Like, who wants to lose money? Nobody wants to lose money. And that's why I think these risk profiles are stupid, because they ask you, questions like, if your investment went down 20%, what would you do? Well, most people that I know would panic. They would be like, oh my God, I've lost 20% of my money. Or you've lost it, Mr. or Mrs. Advisor. And so that's not a good thing. So look, let's just cut the BS, right? Nobody wants to lose money, and everybody wants to make money. We're human beings. That is how we're wired. But we don't have a system that enables that. It doesn't enable you to be flexible and move with the business cycle. And that's what I want to go into now, is this understanding of what is full cycle investing. And I love this quote from J. Paul Getty, which is, no one can possibly achieve any real lasting success in business or get rich in business rather by being a conformist. And that quote completely resonates with me, because I have always viewed myself and my firm as an outlier, as a nonconformist, because let's face it, right now, once again, we have a whole class of investor, and they're typically the superannuants who are getting completely cleaned up right now by these market movements, because the establishment, because the advice community doesn't have the tool set, or the tool, I should say, of full cycle investing. So let's just talk about that for 1 second. What is actually being a full cycle investor? Well, being a full cycle investor is actually recognizing, using the tools I've already mentioned, the three-factor model, volatility, and other things, to determine where we're at in the investment cycle. And furthermore, it's also about ascertaining what quadrant you're in, so that you can put on a certain investment playbook. Now, all we're trying to do, and I don't want you to get the impression that I'm some super duper genius level investor. All I'm doing is I'm making observations about the market, as I'm trying to get that incremental increase in performance, in generating alpha for my clients, that will actually make the difference in the long term. And let me tell you this, as I mentioned earlier in this presentation, because we saw an economic slowdown coming, we were able to position our clients basically in cash, but also in other things that perform well in that environment. Now, again, COVID-19 came along and has completely body bagged the U.S. economy, the Chinese economy, economies in Europe, the Australian economy. They're all going to suffer badly. That's an extreme outlier event. Like, if for any of you math nerds in here that might be familiar with standard deviations, like this would be like 4, 5, 6 standard deviations away from what you would expect to be a normal sort of event. And that's pretty extreme. That sort of stuff just doesn't happen. But being a full cycle investor means that you have a tool set to say, okay, what's happening with growth, inflation, and interest rates? Is the economic environment accelerating or decelerating? What's the rate of change of the acceleration or deceleration? How bad is a recession going to be? Is it going to be shallow or is it going to be deep, like a depression? All of these questions get asked, and an answer is postulated in a full cycle investment strategy. And again, what this means is you are repositioning your assets to be more likely to experience a positive return during that environment. Because what happens is that over the long term, it's not being a long-term investor that this whole game is all about. In fact, the best long-term investors are awesome short-term investors. Think about a guy like Warren Buffett. Everybody thinks he's a prolific long-term investor, and I agree with that. He has had one of the best performances of any person managing money on the planet. There's a heck of a lot of other people like Warren Buffett around, mind you, that have also done similar things. But what they've been really good at is managing the short term really well. And I'll give you a quick example. I don't know how much cash Warren Buffett is currently sitting on. Get that out of my mouth. How much cash Warren Buffett is currently sitting on. But in the lead into the GFC during 07 to 2010, Warren Buffett had been heavily invested in cash and treasuries. Now, he kept his regular investment portfolio going because he buys big stakes in companies and they generate a lot of dividend income and the such like. But he didn't reinvest a lot of his cash back into those businesses or buying other businesses because he didn't believe that the market had value in it. Not that value is a big metric for whether you should put capital to work in the market, but he could clearly see that something wasn't right. And along comes the GFC. Now, Warren Buffett, during the GFC, put billions and billions of dollars of his cash hoard to work. He bought big stakes in companies like GE, Wells Fargo, Bank of America. I'm sure the list goes on. But anyway, he was a great short-term investor. At the moment that the market had the most pain and suffering, he was ready with cash. And that is ultimately what being a full cycle investor is all about, is knowing the spot to pick to invest in. Okay, so we've talked a lot about risk profiling, economic models, volatility, being a good short-term investor to be a good long-term investor. So what's the playbook that you should have on right now? Well, as I mentioned throughout this presentation, we are probably entering a depressionary style environment. If you just think about what's happened to the global economy, it has effectively ground to a halt, and that's really, really bad. I mean, it's super, really bad. And so right now, you should probably be out of the stock market. You should not be fully invested. And the reason for that, at least in stocks, the reason for that is because earnings of companies have yet to be revised down. Now, again, this is another metric that we look at for how we look at markets. But if earnings are going to be down, and they will be, a lot of companies are already revising lower. They're saying we can't even give you guidance because we just don't know. I mean, if you think about it, right, there are whole industries that are shut down. The airline industry has probably been 80 or 90% of its capacity is gone. Who's going to restaurants and cafes? Because they can't, right? So the services industry is gone. The restaurant and hotelier industry is going to be completely ravished. There are other industries that are going to be hit very, very hard. Manufacturing is one of those as well. Now, obviously, there are some industries that'll do pretty well. There's certainly some portions of the technology sector that will do okay. But broadly speaking, on the whole, on balance, you cannot right now make an argument to be invested in stocks because we just don't know where the bottom is. So that would be the first thing I would suggest in terms of putting on a playbook to say, look, now's the time to be sitting in cash. If you have lost money already in your superannuation account or maybe in a personal account, I dare say if we get a bounce of some sort in the markets, you would be wise to consider selling into that. Because again, remember what I said right at the beginning of this presentation about bear markets, is you often see these big rallies in bear markets where people go, hooray, we're back to a bull market environment and we've had this V-shaped recovery. Well, I've got news for you. Again, that doesn't happen typically in bear markets. You don't see these sort of V-shaped recoveries. In fact, we're going to be very lucky if we see an extended sort of U-shaped recovery because, again, the economy has been so devastated by COVID-19. So what I'd like to do now is cover off a few FAQs. I'm going to have to put my glasses on to do this, so forgive me for looking down. But I just wanted to cover off a few of the things that, particularly in Australia, that Australians might want to be aware of, and then share with you a few other insights and then give you that resource that I promised that I was going to give you at the beginning of this video. So first of all, how many of you were aware at this stage that you could access your superannuation if you need to, if you are experiencing financial hardship? Well, the fact of the matter is you can. And the government has rolled out a program where you can access $10,000 in this financial year, which ends June 30 of 2020, and then another $10,000 next financial year. Now, the process to do this is you have to have what's called a MyGov account. So the MyGov account is something that pretty much, well, everyone in Australia who's over the age of 18 should probably have one, but certainly you can set one up fairly easily. Just Google MyGov and go set yourself up with that account. The process is you have to apply through MyGov to access your super. So you can't just go and call your fund and say, I need $10,000 or whatever. If you have a self-managed super fund, you can't just go and take the money out. You basically need to get approval from the ATO to do that. So the MyGov website, you'll go in there, there'll be somewhere in there where you'll make an application to do that. They will review it and they will send a letter or some sort of communication, which you will then forward on to your fund. Or if you are a self-managed super fund, then you will just send that to whoever your fund administrator is, just so they have it on file, so that the auditors and so forth are able to have the proof that it was okay for you to take that money out. So that's the process to use for that. I'm getting asked a lot, how bad is this economic downturn going to be? And I think that right now no one knows. Again, we're not really going to know until we're well and truly through all of this and we're looking back probably 3-4 years after the event. But having said that, I think it's going to get a lot worse before it gets better. And so I don't want to be one of these Pollyannas who just runs around saying, oh, look for opportunity and all this stuff. Yes, there will be opportunity. Don't get me wrong. I mean, trust me when I say this, at a certain point, when I see the data suggesting it, I'm going to be piling my clients back into equities and stocks and all the growth stuff. But that's not, I dare say that's not going to be for months and months, because we have to work through this cycle. And if I could just sort of look back at history, the Great Depression lasted, the whole period of time of the Great Depression in financial markets lasted 44 months. A typical recession will last 9 months. A recessionary environment will last 9 months. And the average is, I think, somewhere around 14 months. So literally this COVID-19 thing has just started to affect the global economy in the last 1 to 2 months. So there's a lot of time and space between now and when we can call for a recovery. Okay, so how are we going to know that it's ending? Well, again, it goes back to looking at the economic data. We want to be able to see economic data improving and incrementally improving, not just, a one-off sort of number. We want to see a lot of economic data getting a lot better. And as it does, that will then give us confidence, at least as investors, that it's time to go back into the market. You need to protect your capital right now. And even if that means at the moment you have to crystallize a loss or you have to take a loss, you know what? It's better to have a 10, 15, 20% loss than to have your capital go down 40 or 50%, because the reality is, and you probably could do the math on this, you would know this, right? If you have a 50% loss, you have to have 100% gain just to get back to even. Now, if you have a 50% loss in your capital, you won't recover for years and years. And again, this is why I use a full cycle investing model, because it means we get out of stuff. Even if there's a small loss, we get out of it, that's fine, but you want to preserve capital. And that's one of the key messages that I'm hoping you're getting loud and clear from me, is you must preserve your nest egg. You must preserve whatever wealth you have in your family. You must preserve that now, because that's your ammunition, that's your firepower for when the market actually turns. So one of the final things I often get asked is, or a statement I hear being made is, stocks look really cheap right now. Should I be buying stocks? And again, in bear markets, this is exactly what happens. Is bear markets have bounces, and people think, oh, this is it. This is the beginning of the next bull market. So they then feel compelled to go and buy stocks, but they don't have that overlay, that structure that I talked about, that prism of full cycle investing, of growth, inflation, and interest rates to guide them to say, well, hang on a minute. Has anything actually changed in the economic narrative that suggests that the stock market should be going up? I mean, you know what? Stocks go down and they go up. And these are the things that happen on a day-to-day basis. But what I'm telling you is, over that short and medium term, particularly in bear markets, you get bounces. They should be sold. And if you get some recovery of your capital during that bounce, you should take that opportunity to sell. And now is definitely not, it is April of 2020. Now is definitely not the time to be looking at a fully allocated stock portfolio. Thank you very much for sticking around to the end of this video. It's been great to hopefully give you some information that's going to give you the ability, I should say, to make better financial decisions around this evolving market situation. And once again, please, if you do have any questions or comments, hit me up in that. But now let me just share with you what I am doing for the Dent community, which I'm so proud and pleased to be a part of. There are some incredible people in this community and doing great things as well. So this is my opportunity to help you with some more knowledge and learnings around this. So I've created a web page on my site. It will only be visible to people with this URL, and that's www.keystonefinancial.com.au/KPI. And on that site it's a bit like Capcom. If you're a bit of a space nerd, then you know that Capcom is the one person in mission control that talks to the astronauts. And the reason for that is because, you know, if you've ever seen any of these movies, you know that there's 40 or 50 different people inside mission control that are each tracking their own little, metric and own little system of the spacecraft. And if they all tried to talk to the astronauts at once, mass confusion would reign, and the message of whatever needed to be put through would not be put through, and confusion would ensue, and of course they would probably prioritize the wrong thing. So I call this webpage Capcom for you, because what you need is one voice. So my firm is on a mission, one voice, one mission, and that's to protect and risk manage your capital. So on that page, you're going to see first of all, some links to all the government programs and things going on. So jump on those links. They'll probably pop you over to the Treasury website, or you'll download some of the fact sheets. So if you're a small business person, there's some fact sheets there for what you can do to help your business, maybe get some cash flow, or how to seek remedy from landlords and the such like, some of those resources. I'm also going to have on there a bit more of a detailed playbook for you as to how you should be investing your capital during this period of time. I will give you the current quad map, and I'll probably do that for the 4 or 5 key countries that I know the Dent community is most prolific in. And there's a bunch of videos there as well that I've been shooting. So one of the things I do for my clients is I communicate with them regularly, especially in this environment. I've been recording updates just from my computer with my little headset on. I look like I'm I'm a pilot in a cockpit or something like that. But I just shoot 10 to 15, maybe sometimes 20-minute videos on what the heck is going on, just to give my clients more information about the current situation and to put them at ease and give them confidence that I am doing the right thing around their money, and that I am bolted in the chair and paying attention to what the hell's going on in financial markets, because that's what you have to do in an environment like this, is really keep on top of this stuff. So you've got access to those videos, and I'll post more into that webpage as well. Consume them at your will. There's absolutely no obligation to do anything. You don't have to give me any of your details. No signups required, none of that stuff. I want you to have this information with the caveat though, please, if you're going to act on anything I tell you, once again, remember that general advice warning I gave you. I don't know you individually. I don't know your personal circumstances. So please, if you're going to make any decisions around what you've learned, and believe me, you're going to be able to make some better decisions, please consult with an advisor. And again, consult with somebody that knows what the hell they're doing, that knows how to risk manage money. And by all means, if you would like to contact me, my email details will be there. My mobile number and contact details for Australia will be there. I run a global firm in terms of global macro investing and access to a global platform to do that. And so I would be all too happy to share with you my insights and my wisdom that I've gained over the last 25 years or so in financial markets. So once again, ladies and gentlemen, thank you so much. Big shout out to Glenn and the gang at Dent. I really appreciate the opportunity to share my insights with you guys. I do hope that we all survive, and I know we will, this next 6 to 12 month period with our capital and our money intact, and of course our family's health and our individual health intact. So ladies and gentlemen, thank you once again, and I will hopefully see you all again at some point soon.
For more expert talks, just visit dent.global/reinvent, because we believe that the decisions that you make now matter more than ever. We started Dent 10 years ago in the middle of the GFC in London, and we shared the key person of influence methodology as a tool to be able to help businesses thrive despite the chaos. Today, it's a best-selling book, and over 3,000 businesses use the methodology like an operating system for driving performance. And we've learned that regardless of economic conditions, that your primary focus as a founder should be showing up as the go-to brand, the key person of influence in your industry. More important than systems or social media, more important than Facebook videos or launching a website, the goal of showing up as the key person of influence in your industry should be the organizing force. It should be the primary objective that helps align all your other decision making. Because as your influence and reach expands, it becomes easier and cheaper to attract clients, team, media, even investors. When times are tough, it's the key people of influence that become even more valuable and even more in demand. And if you've been in business for a while, you're probably a lot closer than you think. So every week that this COVID-19 thing continues, I'm going to be hosting a weekly talk to be able to help business leaders like yourself recalibrate their focus so they can make the most of the times that we're in. If you're interested in jumping on a Zoom and saying hi with me, you can find the link to register for my sessions as well as all of the crisis response team sessions at dent.global/reinvent. If you found this useful, let us know. My name's Glenn Carlson, and please be brave, have fun. Let's go make a dent in the universe.